Something extraordinary just happened in the gold market that nobody's talking about. And when I show you what it is, you're going to understand why central banks around the world are quietly panicking right now. Because what we're witnessing isn't just another price move. It's a signal, a warning shot across the bow of the entire financial system. And the implications of what's unfolding are so massive that most people won't realize what hit them until it's too late. Let me paint you a picture of what's really going on here. Gold just breached $4,400 per ounce. Think about that for a second. $4,400. That's not a typo. We're not talking about some modest rally or a temporary spike driven by fear. We're talking about gold achieving over 50 all-time highs in a single year, delivering returns exceeding 60%, and showing absolutely no signs of slowing down. But here's what makes this different from every other gold rally you've ever seen. This isn't retail investors piling in. This isn't gold bugs finally getting their moment. This is institutional money. This is sovereign wealth. This is central banks themselves abandoning their own system. And that should terrify you. Because when the very institutions that control the printing presses start hoarding the one asset they can't create out of thin air, they're telling you something. They're screaming it, actually. They just don't want you to hear it yet. Let me show you exactly what's happening behind the scenes, because the mainstream financial media is completely missing the story. They're focused on the price. They're talking about technical levels and chart patterns, but they're ignoring the elephant in the room. Central banks have been net buyers of gold for over a decade now. But what's happening right now is unprecedented. We're seeing accumulation at a pace that hasn't been witnessed since the collapse of Bretton Woods. Major institutions are pulling physical metal out of the market at rates that are creating actual supply constraints. The COMEX inventories are being drained. The LBMA is seeing unprecedented withdrawals. And the premium for physical delivery over paper contracts is widening to levels that suggest something is fundamentally broken in the pricing mechanism. Think about what that means. The paper market, where most gold trading happens, is diverging from the physical market where actual metal changes hands. That's not supposed to happen in a functioning market. That's a sign of stress. That's a sign that the game is changing. And the central banks know it. Here's what they're not telling you. The dollar-based financial system that's dominated global trade for the past 80 years is facing its most serious challenge since its inception. We're watching the slow-motion collapse of dollar hegemony, and gold is the canary in the coal mine. Look at what's happening with the BRICS nations. They're not just talking about alternatives to the dollar anymore. They're building them. They're settling trade in local currencies. They're creating new payment systems that bypass SWIFT entirely. And they're backing these initiatives with gold. Real, physical gold. China hasn't reported its official gold reserves accurately in years, but independent analysis suggests they've been accumulating at a rate that would make them one of the largest holders in the world. Russia has been converting dollar reserves into gold systematically since the sanctions began. India is buying, Turkey is buying. Even countries that have traditionally been aligned with Western financial interests are quietly diversifying away from dollar assets and into precious metals. This isn't conspiracy theory. This is documented fact. You can see it in the import data. You can see it in the refinery reports. You can see it in the physical flows of metal from west to east. And here's the kicker. The Western central banks, the ones who spent decades telling us that gold was a barbarous relic with no place in a modern financial system, are now scrambling to make sure they have enough of it. The Federal Reserve holds over 8,000 tons of gold. Why? If gold is just a pet rock with no intrinsic value, why does the Fed maintain the largest gold reserve in the world? Why do they store it in a vault deep under Manhattan, guarded like it's the most valuable asset on Earth? Because they know. They've always known. Gold is the ultimate form of money. It's the only asset that's not simultaneously someone else's liability. It's the only thing that can't be printed, debased, or inflated away, and when the system they've built starts to crack, gold is the foundation they'll fall back on. Now let me tell you what's driving this current move, because it's not just one thing. It's a perfect storm of factors that are all converging at the same time. First, you've got tariff uncertainty creating chaos in global trade. When countries can't rely on stable trade relationships, they hoard hard assets. Gold becomes the safe haven. But it's more than that. Tariffs are inflationary. They raise the cost of goods, and when inflation starts to rear its head again, gold becomes the inflation hedge that actually works. Second, you've got ETF flows that are absolutely massive. Institutional investors are pouring money into gold-backed exchange-traded funds at a rate we haven't seen since the financial crisis. These aren't mom-and-pop investors buying a few shares. These are pension funds, sovereign wealth funds, and family offices allocating serious capital to precious metals. They're looking at the macro picture and they're getting defensive. Third, and this is the big one, you've got a crisis of confidence in fiat currency. People are starting to wake up to the fact that the money in their bank account is just numbers on a screen, backed by nothing but the promise of a government that's drowning in debt. The United States is running deficits that would have been unthinkable a generation ago. The national debt is approaching levels that mathematically cannot be repaid through taxation alone. The only way out is inflation. Print more money, devalue the debt, and hope nobody notices. But people are noticing, and they're buying gold. Now, here's where it gets really interesting. Let me take you back to 1971 for a moment, because what's happening now rhymes with what happened then in ways that should make your hair stand on end. In August of 1971, President Nixon closed the gold window. He ended the convertibility of dollars into gold, effectively ending the Bretton Woods system and ushering in the era of pure fiat currency. At the time, gold was trading at $35 per ounce. That was the official price, fixed by international agreement. Within a decade, gold had risen to over $800 per ounce. That's a 2,200% increase. And it wasn't because gold became more valuable. It was because the dollar became less valuable. The purchasing power of the dollar collapsed as inflation ravaged the economy through the 1970s. Now, fast forward to today. We're in a similar situation, except the stakes are even higher. Back then, the dollar was backed by the largest economy in the world, minimal debt, and the credibility of American power at its peak. Today, the dollar is backed by an economy that's increasingly financialized, debt levels that are astronomical, and a geopolitical landscape where American influence is being challenged on every front. The parallels are striking. And if history is any guide, we're in the early innings of a repricing event that's going to make the 1970s look tame by comparison. But let me give you another historical example that's even more relevant. Let's talk about 2008. When the financial crisis hit, gold was trading around $800 per ounce. The Fed responded with unprecedented monetary stimulus. Quantitative easing, zero interest rates, emergency lending facilities. They printed trillions of dollars to bail out the banking system. And what happened to gold? It went from $800 to over $1,900 by 2011. It more than doubled in less than 3 years. Now look at what's happened since the pandemic. The Fed has printed more money in the last few years than in the entire history of the Federal Reserve combined. The balance sheet exploded, the money supply went vertical, and we're just now starting to see the consequences. Gold is telling you that the inflation story isn't over. It's telling you that the currency debasement is accelerating. It's telling you that the endgame for this monetary experiment is going to be painful. And the central banks are listening. Here's something most people don't understand about how the gold market actually works. There's the paper market, and there's the physical market, and they're supposed to be connected. The paper market is where futures contracts trade on exchanges like the COMEX. It's where banks and hedge funds speculate on the price of gold without ever touching actual metal. The physical market is where real bars and coins change hands, where refineries deliver to vaults, where central banks take possession of actual gold. For decades, these two markets moved in lockstep. The paper price determined the physical price, and everything worked smoothly. But something's breaking down. The paper market is becoming disconnected from physical reality. Here's how you know. The premiums for physical delivery are spiking. If you want to take delivery of actual gold bars from the COMEX, you're paying significantly more than the spot price. That's not normal. In a functioning market, arbitrage should eliminate those premiums almost instantly. But they're persisting, they're widening. That tells you there's a shortage of physical metal relative to the paper claims on that metal. It tells you that there are more people who think they own gold than there is actual gold to deliver. And when that realization hits the broader market, when people start demanding physical delivery en masse, the price is going to do something that will shock everyone. Because here's the dirty secret of the gold market. The vast majority of gold trading is paper. It's contracts, derivatives, ETFs that may or may not be fully backed by physical metal. The actual physical gold market is tiny by comparison. And if even a small percentage of paper gold holders decide they want the real thing, there isn't enough to go around. The central banks know this. That's why they're accumulating physical metal. That's why they're repatriating gold from foreign vaults. That's why Germany spent years bringing its gold reserves back from New York and Paris. They want to make sure that when the music stops, they're holding real assets, not paper promises. Now let me connect this to something that affects you directly, because this isn't just an abstract financial story. This has real implications for your wealth, your retirement, your ability to preserve purchasing power in an environment where everything is getting more expensive. If you're sitting on retirement accounts, IRAs, 401k plans, you need to understand that those accounts are denominated in dollars. And if the dollar is losing purchasing power, your retirement is losing purchasing power. It doesn't matter if your account balance goes up if the money in that account buys less than it did before. That's why more and more people are looking at ways to get physical gold into their retirement accounts. It's not about speculation. It's not about trying to get rich. It's about preservation. It's about making sure that the wealth you've spent decades building doesn't evaporate in a currency crisis. And look, I put together a free guide on how gold IRAs actually work. It's in the description below. It covers the mechanics of how you can get physical gold into a retirement account without triggering tax penalties, what the rules are, what the costs look like. If you've got $100,000 or more in retirement savings, it's worth understanding your options. No pressure, just information. Check it out if it's relevant to your situation. All right, back to where this price is headed next, because that's what everyone wants to know. And the answer is going to surprise you. The major investment banks are now projecting gold to cross $5,000 per ounce by the end of next year. $5,000. That's another 15% from current levels. But here's what they're not telling you. Those projections are based on current trends continuing. They're based on a relatively stable macro environment, with modest inflation and no major geopolitical shocks. What happens if those assumptions are wrong? What happens if inflation comes back harder than expected? What happens if there's a major geopolitical event that shakes confidence in the dollar? What happens if the commercial real estate crisis that's brewing in major cities turns into a banking crisis? What happens if the derivatives market that's built on top of the bond market starts to unwind? In any of those scenarios, $5,000 per ounce starts to look conservative. We could be looking at $6,000, $7,000, even higher. Because at that point, you're not just seeing gold appreciation, you're seeing currency depreciation. You're seeing a flight to safety that overwhelms all other considerations. And here's the thing that keeps me up at night. The system is more fragile than most people realize. We're running on fumes. The only reason we haven't had a major crisis yet is because central banks have been able to paper over every problem with more money printing. But there's a limit to how long that can work. There's a point where the cure becomes worse than the disease. We might be approaching that point right now. Look at what's happening in the bond market. Treasury yields have been volatile. The curve has been inverted for extended periods, which historically signals recession. But the Fed can't raise rates too much because the government can't afford the interest payments on its debt. And they can't lower rates too much because that would reignite inflation. They're trapped. They're stuck between a rock and a hard place with no good options. And the market knows it. That's why gold is rallying. That's why silver is following. That's why real assets across the board are starting to outperform financial assets. People are positioning for the end game. Let me give you another piece of the puzzle that most analysts are missing. The industrial demand for silver is about to explode. Silver is used in solar panels, electric vehicles, electronics, and 1,000 other applications. As the world transitions to renewable energy and electric transportation, the demand for silver is going to skyrocket. But silver production is relatively inelastic. You can't just turn on a switch and produce more silver. It takes years to bring new mines online. What happens when demand exceeds supply in a market that's already tight? The price goes vertical. And because silver is gold's little brother, when silver starts to move, it pulls gold along with it. We could be looking at a precious metals supercycle that lasts for years. But here's what really matters. This isn't about making money on a trade. This is about understanding the fundamental shift that's happening in the global financial system. We're moving from a unipolar world dominated by the dollar to a multipolar world where multiple currencies and assets compete for relevance. And in that transition, gold reasserts itself as the ultimate neutral reserve asset. No country controls gold. No central bank can print it. No government can debase it. It's the one asset that every nation on earth recognizes as valuable. And as trust in fiat currencies erodes, as geopolitical tensions rise, as the old order breaks down, gold becomes the anchor that everyone gravitates toward. The central banks are already there. They've been accumulating for years. They've been preparing for this moment. The question is, are you? Because here's what's going to happen. The mainstream financial media is going to tell you that gold is in a bubble, They're going to say it's overvalued. They're going to trot out analysts who claim that gold has no intrinsic value and that you should stay in stocks and bonds. They're going to tell you that the dollar is strong and that there's nothing to worry about. And they're going to be wrong. Just like they were wrong in the 1970s. Just like they were wrong in 2008. Just like they've been wrong every single time there's been a major monetary crisis. The people who understand what's happening are taking action now. They're not waiting for permission from CNBC or Bloomberg. They're looking at the data, they're reading the signals, and they're positioning themselves accordingly. Let me break down what the smart money is doing right now. Because it's not complicated. They're diversifying out of pure dollar exposure. They're allocating to hard assets. They're buying physical gold and silver. They're looking at mining stocks as leveraged plays on higher metal prices. They're getting exposure to commodities that benefit from inflation. They're reducing their exposure to long-duration bonds that get crushed when rates rise. They're being strategic, and they're doing it quietly because they don't want to create a panic. They don't want everyone rushing for the exits at the same time. But make no mistake, the exits are getting crowded. Here's another angle that nobody's talking about. The derivatives market for gold is enormous. There are trillions of dollars in notional value tied up in gold derivatives, options, futures, swaps, all kinds of complex financial instruments. And a lot of those positions are leveraged. They're bets on bets on bets. What happens when the price of gold moves violently in one direction? What happens when those derivatives start to unwind? What happens when counterparties can't meet their margin calls? You get a cascade. You get a forced liquidation event that amplifies the move in the underlying asset. We saw this happen in the oil market a few years ago when crude went negative. We saw it in the nickel market when prices spiked and the London Metal Exchange had to cancel trades. It can happen in gold too. And if it does, the price could gap higher so fast that it leaves everyone stunned. That's the risk that the central banks are hedging against. That's why they want physical metal in their vaults, not paper claims. Because when the system seizes up, paper becomes worthless. Only the real thing matters. Now, I want to address something that skeptics always bring up. They say, if gold is so great, why doesn't it pay interest? Why doesn't it generate cash flow? Why would I hold an asset that just sits there? And the answer is simple. Gold is insurance. You don't buy insurance because you expect it to generate income. You buy insurance because you want protection against catastrophic loss. Gold is insurance against monetary catastrophe. It's insurance against government mismanagement. It's insurance against the debasement of your purchasing power. And right now, that insurance is paying off. Because while your savings account is earning maybe 4% interest, gold is up over 60%. While your bond portfolio is underwater because rates have risen, gold is hitting all-time highs. While your stock portfolio is volatile and uncertain, gold is providing stability and appreciation. So the question isn't why would you hold gold? The question is, why wouldn't you? Let me paint you one more scenario, because I want you to understand the full scope of what's possible here. Imagine a world where the dollar loses its reserve currency status. It doesn't have to happen overnight. It can be a gradual process that takes years. But imagine that international trade starts to be settled in a basket of currencies, or in a new digital currency backed by commodities, or in bilateral arrangements that bypass the dollar entirely. What happens to demand for dollars? It collapses. What happens to the value of dollars? It falls. What happens to dollar-denominated assets? They get repriced lower. And what happens to gold? It becomes the ultimate safe haven, the one asset that everyone wants to hold. In that scenario, we're not talking about gold at $5,000 per ounce. We're talking about gold at $10,000, $20,000, maybe higher, because at that point, you're not measuring gold in dollars. You're measuring dollars in gold. The entire paradigm flips. And the central banks are preparing for that possibility. They're making sure they have enough gold to back their currencies if they need to. They're making sure they have the reserves to maintain credibility in a post-dollar world. They're playing the long game. You should be too. Here's the bottom line. Gold just sent a warning to the central banks, and that warning is this: the game is over. The era of unlimited money printing without consequences is ending. The era of dollar dominance is being challenged. The era of financial repression, where savers get crushed by negative real interest rates, is creating a backlash, and gold is the manifestation of that backlash. Every time gold hits a new all-time high, it's a vote of no confidence in the current system. It's the market saying, "We don't trust you anymore. We don't believe your inflation numbers. We don't believe your promises. We want something real. And the central banks can't stop it. They can try to manipulate the paper market. They can try to talk down the price. They can try to convince people that everything is fine. But the physical market doesn't lie. The flows of metal don't lie. The accumulation by sovereign nations doesn't lie. Gold is telling you the truth. The question is, are you listening? Because the people who understand this are going to preserve their wealth through what's coming. The people who ignore it are going to watch their purchasing power evaporate. It's that simple. This isn't fear-mongering. This isn't doom and gloom. This is pattern recognition. This is understanding history. This is looking at the data and drawing the logical conclusions. And the conclusion is clear. We're in the early stages of a major monetary reset, and gold is leading the way. The central banks know it, the smart money knows it, and now you know it too. The only question left is, what are you going to do about it?